Hey traders, welcome back to the channel. It is Friday the 13th, and yes, it was an incredibly terrifying day today, just as you might expect, being Friday the 13th. It was ugly. So let's get right into it. Markets tried to bounce back today, and for about 30 minutes this morning, it looked like they might actually pull it off. Luckily, I did all of my trading within the first 20 minutes of the day. I was extremely scalpy today, got in and out real quickly, and I actually did make a little bit of money, small amount, not much, but I went long and I made money, and that's only because I got out within the first 20 minutes of the day. And basically once we got a half hour in, it was just like this all day long. So, once reality set in, it was just downwards pressure all day long for pretty much everything. The S&P 500 closed at 6,632, which was down 0.6% on the day, hitting a new 2026 low and locking in its third straight weekly loss. The Nasdaq also dropped 0.93% to close at 22,105. The Dow held up best out of all three, but it still finished in the red as well at 46,558, which was off about 119 points. On the week, the Dow lost 2%, the S&P lost 1.6%, the Nasdaq dropped 1.3%. 3 ugly weeks in a row for the bulls. What's driving this? Stagflation fear. Oil will just not cool down. Brent crude crossed above $103 a barrel today. That's the first close above $100 since August of 2022. WTI settled in at just under $99. The ongoing U.S., Israel, Iran war has the Strait of Hormuz effectively choked off, and the market is staring down the barrel of energy-driven inflation with no clear exit ramp in sight. The IEA announced a coordinated reserve release. The U.S. even quietly eased Russian oil sanctions to try to expand supply, and nothing has seemed to stop the bleeding so far. On top of this, layer in a GDP number that came in at 2.1% for Q4, which was revised down from the prior reading. Slower growth and higher prices? That's the stagflation cocktail that markets fear the most. The University of Michigan's consumer sentiment reading dropped to 55.5 in March, and the survey director noted that any optimism in early month interviews was completely wiped out once the Iran attacks intensified. That number tells you everything about where consumer confidence is heading. Here's one teachable moment for today: Adobe. The company just reported Q1 earnings that, on paper, were excellent. Revenue is up 12%, they've got a record cash flow, and the AI product line is tripling. They beat on the EPS. So in any other market environment, that stock should have popped really hard today. But instead, what happened? Adobe closed down nearly 7%. Why? Because the company simultaneously announced that CEO Shantanu Narayan, an 18-year veteran, is stepping down. No successor was named. This is a textbook example of why guidance and leadership context always matters more than a headline earnings beat. The market doesn't just buy numbers, it buys confidence in the future. And we've seen this so much in the recent past, with a handful of other tickers that beat earnings and then still trade down pretty sharply the very next day. Who's holding up? Nvidia is quietly outperforming the chaos, catching a bid ahead of its GTC conference next week, where major AI hardware announcements are expected. CF Industries surged over 13%. Fertilizer stocks are rallying hard as the conflict pushes energy and agricultural input costs higher. Energy giants like Chevron and Exxon are green. If you're in the right sectors, this market is actually doing pretty well right now, but just in the right sectors. So next week is the FOMC meeting, March 18th and 19th. Any hope for a spring rate cut has been almost entirely priced out. With oil where it is, the Fed's hands are essentially tied, and whatever Powell says, the market is going to hang on every word. That's it for today. I hope you all have a good weekend, and see you back here on Monday. Take care, everybody.